This is a chart of the S&P 500 stock index. It's a weekly bar chart, and this price action occurred over a certain period in our history where one of the largest financial scandals in U.S. history broke into the news. I want you to look at the chart and see if you can identify where you think this major financial scandal broke into the news. The correct answer was J. The Enron scandal broke into the news in late 2001. This scandal broke out after the S&P 500 stock index had already fallen 39% over an 18-month period from 2000 through 2001. Many people might have selected either letters C, E, or G, possibly, or even H, since most people believe that it is events as reported by the news that cause trends in the market. But as you can see in this example, that was not the case. As a matter of fact, as the scandal unfolded in late 2001 and the beginning of 2002, the market went up, as shown here by the Dow Jones Industrial Average. As these headlines came out in the news, Enron restates earnings, Enron files for Chapter 11, proceeding as biggest ever, and so on, the market continued to proceed upwards. In addition to that, over that same time period, market sentiment continued to go up. The percentage of financial advisors that were bullish increased over that time, as reported by Investors Intelligence Services. And consumer sentiment also went up, as reported by the University of Michigan Consumer Sentiment Report. In late 2001 and beginning of 2002, we had experienced the anthrax attacks. As the attacks occurred, and these are all various headlines depicting that, the market moved upward. Have you ever noticed that oftentimes, just when things look their worst, the market doesn't crash? As a matter of fact, it tends to go up. And just when things look their best, or the most rosy, the market tends to go down, or it crashes. Both phenomena are shown in this chart of stock prices over the last 3 centuries. We see this same phenomenon with GDP data. This is quarterly GDP data, and this is a chart of the Dow Jones Industrial Average from the 1970s to the early 2000s. We see that after the release of major negative GDP numbers, the market, for the most part, tended to rise. And after major positive GDP data, the market often fell, just the opposite of what most market analysts and investors expect. And the same holds true for political events. This is a chart of the Dow Jones Industrial Average from the 1920s to the early 2000s. After a series of significant negative political events back in the 1930s and 40s, Hitler rising to power, World War II, the Holocaust, and so on, the U.S. market rose into the 1960s. And after a series of major positive political events in the 1990s, the European Monetary Union, China's entry into normal trade status with the U.S., for example, the market fell precipitously. Although not easy to see in the Dow on a log scale from 2000 to 2002, the Dow lost about 39% of its value, while the S&P 500 stock index lost about 50% and the NASDAQ about 80%. It is entrenched in our thinking that events, as reported in the news, move markets and cause market trends, as you see by these headlines. Even certain political events, people feel, cause the markets to move up and down, as shown on this headline. And when the effect is no longer there, we categorize it by using that event and saying that the effect of that event has diminished or petered out. When markets rise, even with negative economic statistics, we're surprised, and we say they went up despite the downbeat statistics, as shown on this headline and in this data here, as the market in this particular week went up despite negative economic news. What about natural disasters, like the tsunami that took place back in December of 2004? These are the 5 countries most directly affected by the tsunami, and these are charts of their respective stock markets. The dotted line indicates the day that the tsunami took place. And as you can see, in 4 out of the 5 countries, the stock market continued to rise after that natural disaster, which killed over 250,000 people and caused billions of dollars in damage. Only in Sri Lanka did the market fall initially, but then recovered shortly thereafter. Investors are often fooled by a deluge of information, economic conditions, GDP data, political news, and other events, which lure them into the market just at the worst time, when it's a time to sell, and forces them out of the market at just the best time to buy stocks. If you look at this chart of the S&P 500 stock index from the 1970s to the 2000s, you'll see what I mean. Below the stock chart is a chart of stock mutual funds cash to assets ratio over the same time period. When this percentage of cash is high, it means that as a whole, mutual funds are highly divested of stocks, indicated by the word sold. And when this percentage is low, it means that mutual funds are heavily invested in stocks, indicated by the word bought. Notice that these funds have mainly bought at tops and sold at bottoms. This is common among individual investors and difficult to avoid if one relies on traditional macroeconomic models to forecast. As one Nobel Prize-winning economist from the University of Chicago said years ago, quote, "Economic reasoning will be of no value in cases of uncertainty." But isn't that what we have in financial markets? Cases of uncertainty? We need a different type of reasoning, one that will help us to avoid the pitfalls that we looked at on those previous charts. That's why the wave principle is so important. It offers a unique perspective and a market discipline of rules and guidelines that help investors to avoid investing at tops and liquidating at bottoms. It helps to explain and understand trends before they happen. Many people believe in what we call the standard view, external cause and effect, action and reaction. They see economic and political events and other social actions as external to the system, causing an impact on the marketplace. Once an event occurs, they expect the market to move basically in a straight line or a linear relationship until some other event comes along to change that. And since we cannot predict all of these events, most people feel that markets are unpredictable. Economists and market analysts have long tried to apply the basic laws of supply and demand, or Economics 101, to explain price behavior in financial markets. They refer to this model as the efficient market hypothesis, where you see consumers demand more at lower prices and demand less at higher prices, and producers are willing to supply more at higher prices and supply less at lower prices. Consumers and producers are fully informed. They both want to maximize their wealth. They act rationally, and values are arrived at objectively, and producers and consumers agree on a price to transact at what's called the equilibrium price. In financial markets, we see a totally different picture. Issuers and investors want the same thing. They agree at all prices. Investors want prices higher and get more interested and excited as prices of financial assets move higher. Issuers also want prices higher because they can raise more capital at higher prices, whether in the stock market or in the bond market. Let's look at an example of how investors in financial markets behave the opposite of consumers in markets for your basic goods and services. At the top of this chart is the Standard & Poor's 500 stock index, and below that is stocks as a percentage of household financial assets. And if we look at this chart, which covers the 1960s up to the early 2000s, we see that as the price in the markets decline, the demand for stocks decline, as expressed as that ratio as a percentage of household financial assets. When prices rose, the demand rose, exactly the opposite of what you would expect for basic goods and services. The process is being driven by an emotional, unconscious response by investors who look at the market subjectively and impulsively, who must make decisions under conditions of ignorance and uncertainty. Prices cannot revert to a particular equilibrium point. Most people tend to engage in what we call herding. They follow the actions of others, whether those others are on the right side of the market or not. The result is that prices move up and down according to investors' optimism and pessimism. Investors will use the news to rationalize their emotional decisions, and most people lose money. Now, what do we mean by that most people lose money? We looked at this chart earlier in the video, and I want to bring it back again to talk about this idea of how herding behavior results in losses. Notice at some of these extremes how these stock mutual funds are heavily invested in stocks just at the top of the market, and that they are divested of stocks or holding much less stock and more cash at major lows in the market. This pattern tends to repeat itself through time, overall resulting in losses by being heavily invested in stocks at major tops and very little invested in stocks at major bottoms. Let's now go back to the supply and demand curve for financial assets. And what we see is that investors and issuers both wanting prices higher, as investors react emotionally and impulsively, engaging in herding behavior, arriving at prices subjectively as prices fluctuate. If investors are engaging in this herding behavior, and both issuers and investors agree at all prices, and both want prices higher, what then governs all these fluctuations that we see in prices in the stock market? The price action is governed by the wave principle. The wave principle states that mankind's progress, properly measured by the stock market, is not a straight line, random, or cyclical. Growth and thereby social systems are moving in a pattern consisting of 5 waves up and 3 waves down. This pattern reflects the alternation of growth and non-growth, or decline. This is the basic pattern, consists of 5 waves up, numbered 1 through 5, followed by 3 waves down, labeled A, B, and C. We also have waves within waves. As you see on this chart, waves 1, 3, and 5 can also subdivide into 5 waves, numbered 1 through 5. Waves 2 and 4 further subdivide into 3 waves, A, B, and C. We call these various subdivisions degrees, or degrees of observation. So in other words, waves 1, 3, and 5 in parentheses may span a 1-year time period, and the waves within those waves may be spanning several months. Here's a more realistic diagram showing you a 5-wave sequence over time. You have waves 1, 2, 3, 4, and 5. And within each waves 1, 3, and 5, they further subdivide into 5 waves. Waves 2 and 4 subdivide into 3. With the wave principle, you can anticipate large and small shifts in math psychology, which drive markets. You can separate yourself from the herd, and you can help yourself minimize the emotions that drive your own investment decisions. Let's look at an example of what I mean by that, minimizing your emotions that drive your own investment decisions. Let's assume that you've just seen this cover of Newsweek, The Incredible Shrinking Dollar, and you've gone right to this article about the US dollar. And when you go to the article, you see this picture. Let's now assume it is 2 weeks later, you're reading the New York Times, and you come across this editorial that appeared in the New York Times 2 weeks after that Newsweek article. Let me read it out loud to you. The recent rally of the United States dollar notwithstanding, the greenback has nowhere to go but down. The dollar's current uptick is just a breather in its overall downward trajectory. The dollar is heading down no matter what. I want you to look at this chart of the US dollar index over a certain time period, and I want you to decide where you think that editorial appeared. That quote, "The dollar is heading down no matter what," appeared right here, letter G. That was April 5th, 2005. It appeared after the dollar had declined for almost 4 years. That same US dollar index chart appeared in Short-Term Update at the end of December 2004. Notice the wave labels. Our analyst for Short-Term Update labeled this decline as waves 1, 2, 3, 4, and 5, all part of wave 1 down in the US dollar index. He then called for a bottom in the dollar index and forecasted a major rise in the US dollar. This is a chart of the US dollar index about 1 year after Short-Term Update's forecast. And as you can see, the US dollar did advance off of that low at the end of 2004. The wave principle isn't always the perfect answer to all your investment and trading decisions. It is a useful tool that can help you make better decisions and help minimize your emotions, especially when they're affected by the news. Besides the New York Times editorial, there was negative news about the dollar appearing in the covers of major news magazines, as shown here. And you see the Elliot wave labels in the US dollar index, along with these magazine covers. Let's take a close-up view. You see The Economist, Let the Dollar Drop, The Disappearing Dollar, and then Newsweek, The Incredible Shrinking Dollar. These magazine covers with negative sentiment on the U.S. dollar index appeared long after the dollar had declined and about the time that short-term update was forecasting a rise in the dollar. News generally lags market trends. It does not lead them, and that's why the wave principle is so important. I hope you will learn more about the wave principle in the future and take advantage of the resources that we have at Elliot Wave International. I hope you enjoyed this video, and thanks very much for your attention.